within the 4 years or 5 years they've been working.
Good morning and welcome to Bloomberg Quint, India's first digital live streaming business news service. I'm Neeraj Shah and you are watching Indian Open. Let's go straight to the headlines. West Bengal Chief Minister Amitava Banerjee stages an overnight dharna in protest of the CBI team questioning Kolkata Police Commissioner in connection with a chit fund scam. CARE Ratings downgrades Diwan Housing's bonds, loans and deposits worth 1.2 lakh crore, citing a sharp reduction in the share price and rise in spreads. A day after approaching NCLT for insolvency proceedings, Reliance Communications says its debt resolution plan stands the same as it was with its lenders. Subhash Chandra-led SL Group buys time till September end to bring in a strategic investor, reaches a formal agreement with lenders. And of course, then the whole thing on the budget as well. And we'll get to that in a bit. In fact, during the day, we'll talk to a lot of experts regarding budget and its implications too. But let's first start off with the trade setup for the day. In news across the world, you could argue that the Cold War heated up because Russia and the US suspended the nuclear disarmament treaty that they had entered into many years ago. And that was essentially the talk of a lot of global websites during the course of the weekend. Before this happened and before the news reports about Japan and South Korea having some frigid ties as well, the world markets were doing okay. The Dow inched up slightly higher and as a result of that posted the longest winning streak since November 2017. That's a 6-week streak. The MSCI Asia Pacific Index too has had its best start since 2012 in the month gone by. And there is a bit of a temporary recovery that almost everybody believes we are seeing. Frankly, if you just look at the Asia Pacific Index and if you just see what's happened in the last few days, there's a bit of a bounce. JP Morgan Asset Management in an interaction to Bloomberg said that there's a bear market bounce in play. Never mind that, there is a bounce that we're seeing and a lot of people believe that this is a temporary recovery for the Asia Pacific Index itself. For our markets, would it be a short-lived rally because the index today or participants today might take cognizance of what is, to a lot of people's mind, a bit of a budget mismatch or a math mismatch, because not too many people are completely sure if the fiscal deficit numbers would stay true. If they do stay true, then what happens to the borrowing numbers? And if all of that is okay, what happens to the capex spends and other spends that the government has put out as well? So a bit of confusion out there. And as a result of that, while there was a rally that we saw in Friday's session, let's see if it comes off a little bit in the session today. Nifty Auto, a large short covering led rally. Not all the numbers post that have been that great. So let's see if this rally lasts or if there is a bit of a cool off. I would reckon that the short covering led rally might show a bit of a cool off in today's session. And precisely what I said, that the question marks, I was scanning a lot of brokerage notes, seem to suggest that maybe, just maybe, the capex spend from the government might go off. And will that lead to some impact on some of the capex and capital good related stocks? I think that's something that you need to monitor today. What are the stocks to monitor in light of how we'll start off? Remember, the SGX Nifty is already showing a sign which is a tick which is marginally in the red. The rest of the Asian screen mixed bag. So no big cues coming in from the rest of the world as well. So to each their own. Starting off with RCom. It's going to seek the debt resolution under insolvency. It's at the NCLT's doorstep. An important one to monitor. Yes, it's a small penny stock, but it matters in terms of the corporate India development as well. Do watch out for this one. I'm not quite sure how Zee would react. It had a big gash in Friday. Presumably some lenders sold the stock, but there is a release from them which says that there's a formal consent that Zee has reached with the lenders, and the lenders have given time till September end for getting in a strategic partner and deleveraging. This is way more than the earlier consent reached. Will this give a bit of a relief to the stock? Under normal circumstances, you would believe that it would. There would not be any kind of selling that the lenders will bring in. But let's wait and watch what happens here. Titan was an interesting one. The Q3 numbers beat estimates. There was a higher revenue growth which aided earnings. The net profit jumped 35% from Titan's side. And CLSA was bullish on Titan. Their headline stated all glitter, but they're maintaining an outperform rating with a revised target price of 1100 rupees, which values the company, according to them, at 45 times FY21 earnings. So good numbers. Let's see what happens here. And then a slew of other good numbers. Equitas, BEML, Divis, a lot of these did very well. Equitas Holdings, the NI jumped 37%. Net profit was up substantially as well versus the net loss. So that one could do well. BEML, the margins improved quite substantially. The profit numbers were up about 168%. So a lot of good numbers that came out. Let's wait and watch how do these react in an otherwise dull day today. However, let's tell you what's lined up on First Word today. It's the collection of the top editorial stories, both market and political, that we believe we should bring to you. And we'll start with the political story. The West Bengal police and the CBI are at loggerheads in Kolkata. What is the legal road ahead? We asked senior Supreme Court lawyer Sanjay Hegde. Budget 2019 may have raised some fiscal concerns, but some sectors stand to benefit from the policies as well. We look at what brokerages are making of some of those. Reliance Communications now hopes that the NCLT will let it sell assets to Reliance Jio. Sajid Mangal Johnson with Arcom's insolvency plan, and he will also tell us about the agreement between Zee promoters and their creditors. And finally, Diwan Housing 2 is in damage control mode after the Cobra Post allegations and the subsequent downgrades. We take a look at what they have planned and the four most important questions that they need to answer. Firstly, the political standoff. The CBI and the West Bengal police are currently at loggerheads after a 30-member team from the investigative agency landed up at the Kolkata Police Commissioner's house last evening. The CBI officials who were there to question him for his connection in at least two Ponzi schemes were detained by the police instead. State Chief Minister Mamata Banerjee has already sat on a dharna in what she claims is the fight to save the constitution. Opposition leaders like Rahul Gandhi, Arvind Kejriwal and Tejasvi Yadav were also very quick to back Mamata's claims. The CBI in turn is going to move the Supreme Court today, seeking a restraining order on the Kolkata Police Commissioner. So what's the legal road ahead to break this standoff? Let's ask senior Supreme Court advocate Sanjay Hegde, who joins us right now on the phone line from Delhi. Mr. Hegde, good having you. Thank you so much for speaking to us at Bloomberg Quint this early in the morning. Firstly, your views on what happened. A lot of talk about whether the CBI landed up there with an arrest warrant and should they have intimated it or should they have landed without a warrant or with a warrant. And two, were the Kolkata police right in detaining a CBI team which presumably had come for mere interrogation and no arrest for 5 hours?
See, both sides have overreacted, have gone much beyond their jurisdictions. Not only did the CBI come to the police commissioner's house on a Sunday without a warrant, and there was an order of judgment of the Calcutta High Court which protected the man from arrest. Now, the common law from which Indian law, the common English law from which an Indian law is derived, says that an Englishman's home is his castle, and though the winds may enter, the King of England may not enter. So given that situation, for the CBI to come in high-handedly on a high horse and say, answer us now on a Sunday, I don't think that was on. Having said that, they are policemen. The Calcutta police are also policemen. For one set of policemen to detain another set of policemen, that too is not on. There were several ways in which the situation could have been handled. But right now we seem, at least to an outsider, it appears that more than egos are involved. And what has really suffered in this is the image of the police, both the central and the state police, as independent investigators. When, no doubt, the matter moves to the Supreme Court, I think that is the basic issue that the Supreme Court will be looking at. Yes, there is a direction from the Supreme Court that the CBI takes over the investigation. Over the past many years, the CBI has complained to the Supreme Court saying that they do not have the manpower to investigate it and they wanted the West Bengal police to assist them. In that situation, to go over without even giving they had given a preliminary notice some time ago. After that, they could have very well followed it up with another notice saying that, okay, we are coming on a working day to the police headquarters. Mind you, right, as far as the gentleman himself is concerned, the questioning would be more on the lines of what investigation the West Bengal police had done under him at a prior point of time. There, to the best of my knowledge, there does not appear to be any direct linkage as far as Mr. Rajiv Kumar is concerned with the financial things that took place in the scam. So this lazy phrasing that Mr. Kumar was involved in the financial scam, that also is not on.
Right.
It does appear to me that both sides went on their high horses. Time to get off the high horse.
Time to get off the high horse. Just wondering, since you brought up that topic as well, the CBI is supposedly going to approach the Supreme Court today for restraining orders or otherwise against the police commissioner too. What do you think is the way forward? What would the CBI's argument be today on the Supreme Court, and how does the court view that?
I would not presume to forecast Supreme Court hearings ahead of an application. But if I were to draw up the CBI's application, it would very well be, sir, you transferred the investigation to us. We went to investigate, and we could not. We were prevented in our investigation by X, Y, Z. But unless the court then takes over the monitoring of the investigation, I don't see how far the court can go ahead. More so when there is a much larger question involved, that is the very validity of the CBI itself was held to be illegal by a judgment of the Guwahati High Court, against which an appeal was filed and which has been pending in the Supreme Court for quite many years. So the CBI, one must remember, is not an all-purpose agency to go all over the country without the consent of the state government. That is the legal position under the legal regime as currently operates. There is no separate Central Bureau of Investigation Act. This has been done by an office order under the Delhi Special Police Establishment Act. That the original contemplation of what the CBI was meant to be it was meant to be an establishment under the Delhi police to look at corruption cases only. However, that role has been expanded greatly, and it is time possibly for the country to contemplate having under legislation an independent investigating agency. Call it the Central Bureau of Investigation or anything else. But that is a much larger question. Now, given the fact that the larger question is pending before the Supreme Court, I do not see how, if there is a determined exposition of all these questions before the Supreme Court, that it would make an emergency order in this one case only.
Got it. Okay. Mr. Hegde, appreciate you taking on this time and giving us your opinion. Thanks so much for being with us today on Bloomberg Quint. Well, let's see. 10:30 a.m. is when the CBI approaches the Supreme Court. Important from a political standpoint, and therefore finds its mention on first word. Well, the most important thing arguably had to be budget. 2019 brought some relief to farmers in the middle class, but raised several questions on the fiscal math as well. So I thought it's best to scan all the brokerage notes that have come out over the weekend and try and figure out the 5 or 6, 7 most important points that brokerages have brought out, some from a sectoral perspective, some from an overall perspective. So start off with the views that brokerages have by and large expressed on what could the RBI do post the budget. And I thought the JM Financial point was interesting, and therefore I bring it up. First up, they are saying the FY19 slippage would, along with the expansionary budget for FY20, reduces, to their mind, the probability of a rate cut in February, unless the RBI sees growth challenges as of paramount importance. So the case for would be, if RBI gives growth challenges paramount importance, the RBI is not supposed to do that, and therefore JM Financial believes that it reduces the probability of a rate cut in the next few days. The other point that was raised was that if it's such an expansionary budget, where does the government cut back expenses? And a lot of people presumed that capex spends would get impacted. So MK has put out that note. They believe that the tax revenue shortfall will create an overall shortfall of about 1.3 to 1.4 lakh crores. Capital outlay estimated to grow at about 20% in FY19 and 5.1% in FY20 can be significantly compromised, which implies, of course, deteriorating quality of fiscal spending. They believe that the impetus to the capital goods sector from higher public spending would wear off. So this whole bounce back in capex cycle that a lot of people believe would happen might be compromised. Don't quite know that, but MK believes that there is a case for that. A lot mentioned on the consumption sector, and I thought Mahesh Nandurkar's quote on that was very pertinent. He believes that the income support scheme for farmers and reduction in income tax rates should help only the low-ticket consumption items. I think that's something that you ought to keep in mind. The autos and the likes went up, but because of the quantum of support that comes in and the reduction in rates and therefore the resultant take home for almost anybody under 5 lakh bracket as well would probably go out and help only low ticket consumption items, not everything. I think there is a wonderful chart in the Bloomberg Quint story which speaks about how in the past when such moves have happened, what kind of spending comes about and gains. And as you can see in the chart, it's essentially spending on food, medical and fuel, not so much on footwear, minor durables, etc. So keep that at the back of your mind. Past history seems to suggest that cars and all don't find a mention really when such moves happen. It's essentially food and very basic staples that tend to get favor. So please be careful if you believe that auto stocks will gain substantial momentum as a result of this. Past history doesn't seem to suggest that. JM Financial again, I thought the note on the tobacco industry was interesting. They believe their analysis seems to suggest that the just released receipt budget of the government does not seem to indicate any need for a steep hike in cigarette taxes for the coming year. A 5 to 6% tax hike, in fact, would give an opportunity for the tobacco companies to take the much needed portfolio level price hike. So this is not a negative for ITC, something that usually happens in every budget, and therefore they believe no negative is positive. The much spoken about industry was real estate. Morgan Stanley has come out with a note on the budget impact on real estate. They say that exemption from tax levy on notional rent for unsold ready inventory by 1 year can result in a saving of about 60 to 70 basis points as a percentage of sale value, of course, of tax savings. According to them, DLF and Oberoi Realty have high complete or near complete inventory and could benefit. However, their top calls, and they remain constructive on the industry, of course, they have a preference for mid-cap stocks, Oberoi Realty, Sobha and Prestige. All of these three are overweight ratings for Morgan Stanley. And lastly, a couple of names. I again quote JM Financial, very elaborate note on the budget impact. They believe that the 2% interest subvention to farmers pursuing the animal husbandry and fisheries sector could have benefit for companies like Godrej Agrovet and Avanti Feeds. So watch out for these. And MK has come out with a note on the budget impact on oil and gas. Believe that the government keeping their FY19 core DBT, LPG, kerosene total subsidy unchanged is a positive for the upstream space as well. And therefore watch out for the likes of ONGC and the others. So that's the summation of what I thought were the most important points that brokerages made with regards to markets and specific sectors. On to other corporate news. After making no headway for 18 months post invoking the strategic debt restructuring scheme, debt laden Reliance Communications has approached the NCLT to resolve its debt worries. The company says that it will push for a similar resolution plan that it earlier pushed with its consortium of lenders. Sajit Mangat is here with the details. Sajit, another case at NCLT's door.
That's true. You know, if you look at Reliance Communications, for the last 2 years, they've been trying to restructure their debt of nearly 47,000 odd crores. They even went to the SDR for that purpose, and as part of the SDR mechanism, they came out with a solution of they will sell off the spectrum, they will monetize the land assets, which is at DAKC, and as far as others, international fiber is concerned, they will try to monetize that as well. Now that has been going for 2 years. The spectrum deal was almost done with Jio, where Jio was buying it out from Reliance Communication, but it got stuck at the DOT level for approvals because DOT was not willing to give a letter of comfort to Jio, saying that whatever liabilities of the spectrum will not fall on Jio, and Jio wanted that in writing from the DOT. And this has been going for last 1.5 years, and now the management has decided to go to NCLT as an involuntary bankruptcy filing, and that would mean that now the IRP will, whenever the filing happens and it gets admitted to NCLT, the IRP will take over the company and it will take on the proceedings of the IBC. It also means that that spectrum sales separately, or for that matter land monetization separately, this is something which is now at risk, because it depends upon who the bidder is. If there's a third bidder that comes into fray saying that he wants to buy out Reliance Communication as a whole, which includes spectrum, which includes their land assets and everything, then it's a tough choice, because Reliance Communication is now saying that they're going to propose the same scheme to NCLT when it was outside IBC. Now that's a conference which the management is coming in from, but IBC is a different process. So you have to follow the rules of the game for that, and it needs to be seen how it plays out in the IBC, because from a spectrum point of view, they already have a sharing and trading agreement with Jio. For 850 megawatts in 3 or 4 circles there. Now these are small chunks of spectrum which no other telecom operator can do it, because telecom operators don't have, others like Airtel or for Vodafone Idea don't have 850, and even if you want to acquire it, you need to have a minimum of 5, and this is much below 5. So it's only Jio who can do it, because it adds to the existing spectrum and takes it to a 5 band. Now if Jio is not able to do it, then its entire operation, these 3 circles are at risk. At the same time, if Jio is going to NCLT, it will hard bargain to get it at a lower cost. Okay. So it's it's going to be a wait and watch whether Jio will be able to get the spectrum and all. So it's next 6 to 9 months, or until end of 2019. That's when the ARCOM plans to finish off the entire process. You may end up seeing a new player who is owning Reliance Communication, or there is a hiving off of all the assets which happens into various entities.
Well, let's see. If that was interesting, the other one is even more interesting, because another debt-laden entity, SL Group, has bought some time from its lenders. The Zee promoters have reached a formal agreement which gives them time till September end to bring in a strategic investor. Tell us about this agreement. Not something that we usually see.
It's a little perplexing, because lenders which comprises of mutual funds and NBFCs have agreed for a standstill agreement, which basically means that they will not invoke a default in case the coverage falls below 1.5 or 2 times the loan amount. Now remember, there's nearly 7,500 crores of exposure of mutual funds and 4,000 odd crore exposure of NBFCs. The others are banks which have some exposure in some form into the operating infra companies of SL Group. Now how it will pan out, it's a little difficult to say, because they have given 8 months. The stock has already fallen around 25% from the beginning of the year, and if it falls down further another 25-30%, I don't know how recovery is going to happen, because anyone who is going to come into Zee to buy that 50% of promoter will have that leverage, because he or she knows that this company is in a distressed sale and promoters have to sell out, otherwise all the stock will be sold in the market come September. Now why the mutual funds agreed to September 2018? One reason is that we want to give them a chance to get it, but the issue is
it saves the haircut on the NAV. Supposedly.
It basically pushing the can down the road, simple, right? I mean, you are trying to sell assets in infra which are not going to be sold, because island infra assets are still likely to be taken up. You have Zee, which stock price will always be under pressure, irrespective of what happens, because you know that there's an apparent sale going to happen. At what rate, and will the bidder be able to bring in that premium, which we don't know. So these are the 2 things which is there. The question is whether the mutual funds are acting in the fiduciary duty, because their job is to take care of the investors. Now you cannot come back to the investors, say you stay invested for us for 1 year and we'll ensure that it happens. What if it doesn't happen? Are they guaranteeing them?
Or what if it happens at a lower price?
Are they guaranteeing the investor that we will give you the same amount back? Are the trustees or the AMCs or the management are guaranteeing the investor that we assure you that this return will not take a markdown? If the markdown happens, it will take it on our balance sheet and not on your NAVs.
Yeah.
NAVs? No, that's not something which is coming through very clearly. And we also
that's not coming through. There is no clarity required. That's not coming through. I don't think the AMC will be able to make such a promise.
Exactly. So someone has to ask that question to the AMCs, that whether they are assuring the investors or not. we don't even know the terms and conditions of this formal consent.
It's coming late.
Except
late
for
yesterday.
yeah, it came in yesterday. It just says that they've agreed not to invoke default, and they've given time till September 2019. Now it's a question of, you know, when there are lots of ifs and buts which are there. To be clear that, you know, on 25th there was a big block deal which happened of one of the lenders. The company was supposed to disclose the name of the lender. It hasn't. The only disclosure that came in is that Schroders bought 0.7% in the company, and that disclosure also came in, I think, over the weekend or on Friday.
Yeah.
It came in. So Schroders increased the stake to around 7.4%, 7.5%,
0.75%.
0.75%.
Who sold is not known.
Who sold is not known. So, you know, so we still don't know whether it is going to how it's going to play out. Of course, there's a con call happening at 8:30 today morning, so we'll have some more details.
Yeah, let's hope for that. So that's a con call that we'll watch out for. We'll also watch out for a con call at 10 and maybe an interaction before that on Diwan Housing. That's the last piece on First Word. Sajid, thanks so much for bringing us both of these. I'll make it very quick. DHFL, it remains a stock in focus predominantly because of the sharp cuts. It sold its entire stake in one of its affiliate companies, Aadhar Housing Finance, as well over the weekend. It comes in the wake of the Cobra Post report, of course, which alleges that the promoters used all of these companies to carry out a 31,000 rupees crore scam. Now, the damage control mode for DHFL, they've sold their 9.15% stake in Aadhar Housing Finance to Blackstone. It hopes to raise 4,000 to 5,000 crores by selling finance projects. Independent chartered accountant has been appointed to verify Cobra Post allegations, but there are tougher days ahead because of multiple reasons. One, Care Ratings has downgraded the multiple debt instruments by a notch, and therefore it brings into question mark the kind of liquidity that DHFL can raise and what happens to the business at hand as well. So therefore, on DHFL, I'll just sum it up with the 4 questions that I believe DHFL is supposed to answer to almost every single stakeholder and investor. 1, how long will it take to complete the due diligence that DHFL has already spoken about? 2, why were the allegations not disclosed when the whistleblower first filed these allegations? 3, do any of the companies DHFL has extended loans to are of lower net worth? And who are the beneficiaries of these companies? Is anybody in DHFL, the promoter family or persons acting in concert, the ultimate beneficiaries of these companies, or no? Are they able to completely deny that? That's the question. And lastly, if you just look at the numbers, disbursements have fallen, and post the ratings downgrade, how difficult does it become for DHFL to raise funds for further business? If they can answer 4 of these questions satisfactorily, I think they would have done the investor community a world of service. That's all that we have on First Word today. Lots more lined up for you on Indian Open. We discussed the global and domestic macro headwinds for Indian markets post-budget with Vineet Thogre of Mirae Asset Global Investments, and the government's fiscal math and borrowing trends as announced in the budget with Pranjul Bhandari of HSBC. But after this break, a full tilt towards the day's trade.
City Union Bank, trust and excellence since 1904. City Union Bank, trust and excellence since 1904.
Today we are meeting Royston Abel, theatre director. Royston believes you don't need words to tell stories. There is no way to describe what Royston does, because what Royston does defies definition. Can you say that about anyone else? To be so fiercely individual, yet create music and theatre so accessible, so easily understood and felt and appreciated, not just at home, but the world over. When he turned his eye homeward, he created shows that travelled the world, bringing it a glimpse of our culture. The Manganeer Seduction, the Manganeer Classroom, 100 Charmers and the Kitchen. Watch his exceptional story, Pursuits by Skoda, only on Bloomberg Quint.
Anything and everything about your investments. We're just a touch away. Monday to Friday at 12:30 p.m. only on Bloomberg Quint.
City Union Bank, trust and excellence since 1904. City Union Bank, trust and excellence since 1904.
Welcome back. You're watching IndianOpen right here on Bloomberg Quint Live. A quick look across Asia before we get in some commentary from our experts as to how the day is going to shape up. Right now, Nikkei 225 trading high by about 0.5%, a flattish move for Hang Seng, but SGX Nifty is traded lower right now, so 0.25% given up on the SGX. That's down about 25 points. On Friday's session, the index post the immediate budget announcement saw an uptick of almost 1.5%, but once the fine print started trickling in, that started reversing, and we finally ended up the day with just 0.5% in terms of gains. This is the new week now that we're starting off. The week gone by, the index saw a gain of 1.5%. Avinash Gorakshakar, head of research at Joindre Capital, is here with us to run us through what he expects this week to look like, and probably a view on the near term as well. Avinash, Friday session, obviously the kind of reaction we saw to the budget, but leaving that aside, markets primarily not too affected by what the budget does. What's your sense now as we start moving into the year?
My guess is, Devina, I think the budget was on expected lines. I think a lot of populist measures were announced, and I think now going forward, once the budget fine print has been analyzed, I would believe that the markets would again focus on earnings. And I think clearly a lot of corporate news flows have happened at the end of the week, especially as far as companies like Reliance Communications, Diwan Housing. Typically, I would believe that the week could possibly start on a slightly volatile note, and specific companies which have been in the news flows, for the wrong reasons, I think there we could see a lot of action. Broadly, I think today is also an earnings heavy day, so you're going to see a lot of stock specific activity. But broadly, my sense is the markets may probably consolidate or maybe remain where it is. It may not rally immediately, considering the fact that the kind of budget which was announced is still not the kind of budget everyone expected. I think the 75,000 crore kind of give back has been primarily done with a view considering the Lok Sabha election. So I would believe that the budget apart, clearly it's going to be earnings which are going to be more important, and I think if earnings are better than expectations, you're going to see a lot of stock specific kind of moves in the market.
All right, since you spoke about earnings, let's take a look at Titan, and how do you expect that to move? Because it was a strong quarter for Titan, and across the board, if you see, the revenues have seen an increment. Jewelry business particularly, a 37% increase in revenues. Their margins expanded from 10.8% to 13.3%.
No, I think numbers were definitely much better than what the street expected, and I think you could possibly see a good positive bounce on the stock, considering the fact that the jewelry business is the heart of the business, generates a large amount of EBITDA to the overall profitability. I would believe that the stock should open positive, and I think clearly in terms of numbers, both on the top line as well as on the profitability, the beat was definitely positive.
What did you make of the development at Zee, the formal consent with the lenders? Do you think that gives a floor to the price, or do you think that over a period of 1.5 months there could be a higher risk of more downsides?
No, in fact, Neeraj, this is definitely a good positive part from the promoters. But as far as the sentiment goes, I would believe that the stock is not going to see any upside, at least in the near term. On the downside, my guess is as news flow comes in, the management has clearly said that even before April they could rope in some strategic investors. So clearly it's going to be a wait and watch game, and I would believe that in the near term the stock is going to be weak. I wouldn't be surprised that a lot of institutional as well as HNI investors could possibly see this very cautiously, because any delay here could possibly mean that the pledging kind of issue could possibly have an overhang on the stock.
Yeah. So now the question is, purely from a valuation perspective, looking at the earnings that have been reported thus far, Zee doesn't appear to be an expensive stock.
Exactly.
If it falls another 10%, would you be a buyer or would you shy away?
I think, Neeraj, if you are a short-term trader, just avoid it. But if you are a long-term investor, say over the next, 1 to 2 years, this is definitely a business which is a lucrative business. Cash flows are extremely strong. But I think in the near term, if the investor is willing to face the kind of volatility and see a downside to his cost price, then I think, investors could wait away. But personally, if you want to build a portfolio, I think a 10% fall could possibly mean that it could enter a very lucrative range considering the time horizon.
Interesting. Okay. The other moves that happen, and we'll talk about the auto sales numbers in just a bit, but watch out for the auto companies. A big move, Devina, that came about on Friday's session, maybe led largely by short covering too, and our research team will be in just moments from now ready for the huddle as well to talk about some of these. But a large move Friday, short covering led to. Difficult to figure out if indeed that could last or no, because frankly the budget spend doesn't really mean people will go out and buy cars and bikes in that way. As that chart showed, large portion of such spends happen for staples and food.
Yeah, but you still, I mean, for two-wheelers, you may even look at the entry-level two-wheelers, which could probably benefit, not obviously to that great an extent. The kind of savings that have been put into the hands of the urban mass, the middle class urban mass is not, like you said, that big an amount that they'll go ahead and prepone car purchases instead of just the entry-level two-wheelers probably. But that's something that we'll discuss with our experts as well. But in the meantime, we're going to be
across to our research team.
Our research team is ready with us. We're going to be talking about a lot more in today's session. Some more numbers to watch out for, those auto sales numbers that we've been talking about and how they've actually shaped up. So Yatin and Yash, both of them are here with us. Yatin, let's start off with the auto sales first.
Devina, so I'll wrap up the entire auto sales numbers, for the benefit of our viewers. And talking about the commercial vehicle space first. Tata Motors, the total auto sales numbers were down 8% on a year-on-year basis, slightly weaker. If you look at the MN and CV sales, which is the medium and heavy commercial vehicle sales, they were down nearly 9% on a year-on-year basis. This is against Ashok Leyland, wherein the Jain sales grew 12%, and that was the biggest surprise, and probably the reason why on Friday the stock was up nearly 5-7%. So Ashok Leyland going strong. If you look at Escorts also, the sales were up 13%. Also, Mahindra & Mahindra tractor segment, there also the sales were up almost 1% on a year-on-year basis, meeting the street expectations. Coming to the automotive space and talking about Maruti, their sales were almost flat on a year-on-year basis, but better than the street expectations. The numbers came in at 1.51 lakh units versus our expectation of 1.48 lakh units. So, slightly better than the street expectations. Mahindra & Mahindra, the total, automotive segment sales were up 7%, and that was largely driven by the commercial vehicle segment as well as the light commercial vehicle segment, wherein we had seen some strong growth coming in on an overall basis. In the two-wheeler space, Royal Enfield, in line with expectations. TVS Motors also has been disappointing for quite some time. This is, on the back of weaker scooter sales for TVS Motors, wherein the total sales stood at, 2.82 lakh units, up 4%. Versus our expectation of a 15% growth. So TVS Motors has slightly disappointed the street. Similar is the case with Hero MotoCorp, wherein the January sales have come in at 5.82 lakh units versus 6.41 lakh units, and that was down 9.2%. We were expecting a sales figure number of 6 lakh unit. So clearly a 20,000 unit less than the street expectation is what Hero Moto delivered. So on an overall basis, if you look at it, the weakness continues. However, few companies did manage to beat street expectations.
All right, thanks a lot for that, Yatin. We'll see whether those stocks react to that number or no. Some other stocks in news, Yash.
Right, I'll start with SL Propack, wherein there's an Economic Times report suggesting that French packaging firm Albia and private equity firm Blackstone are in advanced negotiations with the company to acquire a controlling stake. Bloomberg Quint has not individually verified this news. They are sourcing three people who are aware of this development. Along with that, Cyient will also be in focus, where the board of directors of the company have approved to buy back close to 28.5 lakh shares, or about 2.5% stake at a price of about 700 rupees per share, which is at a 15% premium over its current market price. Key earnings to watch out for: Divi's Lab came out with an extremely strong set of numbers. Revenues have grown by about 29.5% to 1,343 crore rupees. Net profit is up 67%, and margins have expanded to 39% versus 31.4% in the same quarter last year. Berger Paints, they came out with an inline set of numbers. Revenues have grown by 21% to 1,600 crore rupees. Net profit is up 3%, while margins, they have come off to 14.5% versus 16.6% in the same quarter last year, and that is on account of the higher raw material prices, something which most of the paint companies have seen in the third quarter. And Godfrey Phillips, that one too came out with a strong set of numbers. Revenues have grown by 13%, EBITDA is up 26.5%, and margins have come in at about now 17.5% versus 15.7%, and a big 26.5% jump in the bottom line as well.
All right, thanks a lot for that, Yash, and Yatin, appreciate it. Avinash, since we were on the topic of the auto sales numbers, and you are seeing a slight bit of recovery in a few of these names, what would your pecking order be now?
Clearly, I think Devina, looking at the two-wheeler numbers as well as numbers from the commercial vehicle sector, I would believe that these two sectors could continue to see some pain. I would believe that if at all one were to look at nimbling into any automotive company, then I think it would be better to look at either Mahindra & Mahindra and Maruti. I think clearly, despite the fact that headwinds are going to be challenging over the next, say, 3 to 4 months, I would believe that hopefully once the bounce happens, Maruti is well positioned in terms of their product bouquet, in terms of their capital gearing, and most importantly, I would believe that clearly in the near term, these volume numbers were more or less on expected lines. So I think on dips, maybe a Maruti or a Mahindra could definitely be a better bet as far as the risk reward is concerned. As far as Tata Motors and Ashok Leyland is concerned, we still believe that the new axle norms as well as the kind of slowdown in the NBFC financing for these segments is going to have an impact on the commercial vehicle sector.
Yeah, well, certainly autos will remain center stage today, predominantly because of the kind of rally that they had in the other day as well. So do watch out for those names. Avinash, any thoughts on Diwan housing? And I don't know if you track AMCs which hold such paper, or if you track AMCs at all or no, but the kind of erosion of net worth could happen as well. A lot of people are saying that Diwan housing could well trigger the second round of the financial issues for some of these AMCs.
In fact, Neeraj, I think already if you ask me, the kind of loss of confidence in Diwan housing as far as the market valuation is concerned has already happened. The management is going to have a conference call today at 10 a.m. to discuss various issues relating, to the credit downgrading as well as the Cobra Post issues. I would still believe that, these are panic measures and possibly the markets are not going to be happy about it. We could see a further downside to the stock considering the fact that a lot of issues have happened quite quickly, and most importantly, now with CARE giving an official downgrade, it's definitely going to be a little bit concerning for most of the asset management companies who own these stocks. So I think not only from the equity side, but in fact the non-convertible debentures which have been subscribed by investors are going to be definitely going to be in question. So I would believe that it's better to avoid this counter at any level now, considering the fact that fundamentals don't seem to justify the price, and most importantly there seems to be something more than fundamentals which has actually triggered this kind of fall.
And the stocks wiped out 53% in a matter of 1 month at 111 right now. Moving on, let's talk a little bit more about a few more stocks that we can keep our eyes out for. IT is a pocket, 2 weeks in a row. The IT index has given you moves of about 4.5%. Is it too fast?
I think, Devina, clearly, if you see the kind of commentary from Fed, that clearly indicates that the US economy is now moving into a healthier territory, and I think markets are betting on the fact that hopefully if the US market recovers, there could be larger order wins for most of the Indian companies, and US remains a big market for most of the Indian IT majors. I would believe that if at all one were to look at IT companies, it's better to bet on the larger names like maybe an HCL Tech or a TCS or a Infosys, but I think the smaller companies could possibly still face considerable headwinds, considering the fact that larger cap companies definitely could get a larger share of the order wins if at all the scenario changes.
So your pecking order is going to be the larger names?
Yeah, large cap names.
All right.
Some results, Devina, that came out, and some pretty interesting. You spoke about Titan. The other one which sounded very interesting was Equitas Holdings, from a loss to a profit, and those numbers looked okay. Deepak Nitrite, the numbers looked fairly okay, and Divi's Lab, I thought the numbers looked rock solid as well. Track any of these?
I think Divi's Labs numbers have been very solid. In fact, Neeraj, within the CRAM space, they are a very large player. And not only has the top line, but EBITDA margins have improved largely because of the fact that the rupee has aided them. But clearly, I would believe that within the CRAM space, this is one player which has a very large exposure to most of the larger US markets and the European markets. So I would believe that Divi's, even at the current odd levels, if one were to look at a slightly medium to longer term picture, could definitely give in a better risk reward, and considering the kind of numbers, I think today morning you could see a strong bounce on the counter.
Okay, so watch out for Divi's Lab. The numbers looked rock solid, as I said. Operational numbers looked also very good. And then of course we'll talk about We'll talk about Equitas. We'll talk about Deepak Nitrite. We'll talk about BEML. I thought those numbers too looked reasonably okay. At least on the operational front, those numbers looked really okay. So we'll talk with Avinash about all of these. But let's get in our technical experts on board. It's also pertinent to take a look at take cognizance of the charts. The SGX Nifty is now indicating a 43-point downtick. Ruchit Jain of Angel Broking with us on the show, as is Brijesh Bhatia, head of research at Dealmoney Securities. Gentlemen, both of you, good morning. Thanks for joining in. Brijesh, let's start off with you. How are you approaching trade this morning? The SGX indicates a start which is marginally lower. What's the trade that you would look to initiate?
I think Nifty is making a range continuation. Last week also we have seen that markets being trying to break out of 11,000, but post budget in the second half of the day we have seen rally being fizzle out, and with around 130 140 points positive, markets turning onto the negative. So I would slightly wait for the current momentum, and one can look for maybe another short straddle or short strangle for quite some time till market is trading in a range. But as of now, index wise, I think there is no trading zone for Nifty or Bank Nifty, and I would slightly wait for markets to either break below 770 for a good confirmation, or above 11,000 on Nifty for quite some time now.
Ruchit, what about you? How are you approaching trade this morning? What's the trade that you are initiating?
Yeah, hi, very good morning, Neeraj. Neeraj, last week we had seen that the markets had shown a pullback from the levels of 10,600. But again, on this, on the day of budget, the index has not managed to take out the 11,000 resistance. So I think yes, clearly, we are still trading within this range of 10,600 to 11,000. And only when we see a breakout above 11,000, I think, then it would be prudent to say that we could see the directional move in the market. So as of now, even we are advising to, keep a wait and watch as far as index trade is concerned. There are good stock specific opportunities available in the market. So on the index, I would take a trade only once we get a breakout above 11,000. Then I would tend to create fresh long positions.
Okay. What about some of your stock ideas? Let's take a look at that as well. Ruchit, we'll keep it with you.
Yeah, so HCL Tech is one of our recommendation at current levels. We have seen that this IT name has given a breakout from a falling trendline resistance on the day when its results were announced. Post the breakout, a good follow-up buying was seen in Friday's session, and that buying has been supported by very good volumes. So I think overall we have seen the entire IT sector has shown a good momentum, specifically some of the large cap names such as Wipro, Infosys, TCS to an extent in last couple of weeks. So I think HCL Tech would now show a good follow-up move, and we can expect the earlier all-time highs of around 1120 in short term. So at current levels, one can go long on HCL Tech, keeping stop below 1005, expecting targets around 1110 to 1120. And Havells is another stock which has been showing positive momentum. It has been one of the outperformer. In spite of what we have seen in the broader market, this stock is trading at its all-time high levels. And technically, this stock has given a breakout from a bullish continuation pattern known as cup and handle in Friday's session. So this should lead to continuation of the outperformance. So traders can go long on Havells with stop below 710, expecting target around 784 in near term.
Right. That's HCL Tech and Havells. Brijesh, your strategies on stocks?
Yeah, I would also recommend HCL Tech for a couple of reasons. So if you look at the IT index, it was been trading into a rectangle formation since October to maybe last week of Jain, and we have seen a good breakout out of the index. And if you look at the history, HCL Tech is slightly a late mover in the IT pack, or especially the large cap packs. So now HCL Tech post result, we have seen good volumes coming up, and the rally has been very strong. So I would also recommend HCL Tech long for the target of 1140, and one can keep a stop loss of around 995. Second stock is Raymond. I was on a sell call on the Raymonds. If you look at the stock, it has been trading below its key averages of 50 days and 200 days, and we have seen after a short momentum, the consolidation was there. In last sessions, we have seen that previous lows being breached again. So at around 746, one can look for short opportunity for the target of around 712 to 690 on the downside, and one can keep a stop loss of 767 on futures level.
All right, those are some stock specific strategies from our technical experts. Let's move on to our special segment, Bloomberg Edge, where Yash Upadhyay tells us about a pattern that the Bloomberg terminal has thrown up on a particular stock. Yash, what's on your radar today?
Good morning, Devina. So we are tracking HUL on the charts and a buy signal coming in on the back of the proprietary trender indicator. Let's first try and understand what it is. It basically is the spread between the true range of the. It uses basically the average true range for its calculation, and it generates a buy and a sell signal. How do you interpret it? You go long when the trend line flips its color from red to green, and you go short when the trend line changes its color from green to red. In the case of HUL, we saw in yesterday's day of trade that it moved up on the back of very heavy volumes, and it ended 2% higher and has been gaining for the last 2 trading sessions. And with this, the red line over here, which is the trend line, that has closed below, or the stock has closed above the mark of the red trend line, which is at 1788. The stock is at 1799, and with that, it has given a positive crossover. Also, the stock is trading above most of its key moving averages, so that possibly indicates that the long-term trend is on the upside.
How well has this worked in the past for HUL?
So Neeraj, 2 out of the last 4 times that the indicator has turned positive, where you could watch out for returns of in excess of 5.5% over the next 1 month.
Okay, so 2 out of the 4 times. So it's a 50-50 kind of a strike rate for the trender for HUL. So interesting one. Are the tailwinds in favor of a stock like HUL because of the budget? Maybe so. Yash, thanks so much for putting that into perspective. Well, seems interesting. 1800 and counting on HUL, the big boy, certainly seems to be doing okay. For a deeper insight on Indian equities, of course, remember, visit BloombergQuint.com, our website, where we identify technical triggers that have emerged on a specific stock or a sector or the index as well. On today's Bloomberg Edge, because the index is so pertinent, we feature some analysis of the Nifty Bank and what do the rollover charts indicate. That is a BQ Blue exclusive. Well, banks have certainly just turned a little bit for the worse. Actually, coming on that before we move back to specific stocks, Brijesh, the Nifty Bank, the last couple of days has started to underperform slightly. The rolls to indicate some weakness. Would you reckon that Nifty Bank could go down, or specific heavyweights within the Nifty Bank could move down further, and you would want to initiate some trades there?
I think if you look at the last week's session, it was mixed bag. HDFC being going good positive. ICICI we have seen profit booking coming in, excess profit booking coming in. Kotak again moving higher. So it was, I think, well managed. And if you look at the bank Nifty the charts, it has been still in a range like Nifty. So I would slightly wait for around 26,000, maybe 26,789 is the strong support. Till those levels are not bridged, I think there could be no fresh shorts being coming up, and markets might continue in a range. I think I would look for a long at around 26,800 in case markets are being slightly dipping, maybe another 250-300 points on the downside. Keeping a strict stop loss of maybe around 26,700. Below those level, I think selling pressure might continue. Otherwise, we are again seeing a good upside around 27,200, 27,300, and a range might continue in Bank Nifty.
Ruchit, post the 17% drop in Vedanta, what would it look like? More weakness, more downside?
So Devina, if I see last 3-4 months, all those stocks which had given a sharp correction in one day, that is more of a 10% or more, all those stocks have tend to underperform so far. So even in Vedanta, I think that no one should not look to do any kind of bottom fishing over here, as this underperformance might continue. Now, Friday's gap area should be seen as a serious concern, because after a consolidation phase of about 3.5 months, this support has been breached with a huge gap. And there would be many traders or investors who have stuck on the long side in this entire consolidation phase. Now, whenever there would be a pullback move, this gap would turn out to be a resistance, and all those traders who have stuck, they would start liquidating their positions, which would again bring some selling pressure or some supply on Vedanta. So clearly it would be, my recommendation would be to avoid any kind of bottom fishing over here. Rather, I think, if I see the Nifty Metal Index or some other stocks within the metal space, then Tata Steel and Hindalco, these two are the names which look quite better in terms of risk-reward ratio. Tata Steel is trading near its weekly 200 moving average, and Hindalco on the daily chart recently during last week has formed a bullish morning star pattern. So I think the risk-reward ratio within the metal space is much in favorable of Tata Steel and Hindalco rather than Vedanta.
The other one is Yes Bank, back to 185 from trading around those 205 levels just a week ago. So the sell-off within this one has also been quite sharp and pacey. Brijesh, Yes Bank now at 185. Do you expect it to take support and bounce back? Because that's the range that it has previously traded in.
Yeah, I think yes, around 179, 78, 79. If you look at the past momentum, a strong accumulation was seen, and I think that levels might again act as a strong support. 180 definitely a good bet to go long, keeping a strict stop loss of around 173, 174 on the downside. And I think slow and steady, it might again reclaim its 200 levels on the upside.
A couple of stocks on which results that we spoke about, on which results have come about. Avinash, Gorakshakar, do you track Equitas Holdings, and what did you make of the numbers?
No, I think numbers definitely much better than what most of the analysts and the street expectations were. I think clearly on the operational side, I think a good improvement. Plus, bottom line has turned back into the green. Our sense is that Neeraj, after a long time, the stock has actually now shown a strong operational beat. Possibly, if the next 1 or 2 quarters the company manages to maintain even these EBITDA margins, the stock definitely could possibly see a significant re-rating. I think from levels of 150, 160, the stock has corrected sharply. So I would believe that these levels, if one were to even invest at the current odd levels, this definitely presents a good opportunity. I think clearly the small finance bank was one driver earlier, but looking at the microfinance kind of space in which they operate, I would believe that this level definitely looks attractive from a long-term point.
Okay. The other one was Deepak Nitrite, and while lots of lofty expectations because of the phenol plant, the numbers don't seem bad, but have they missed the mark, or are you happy with the performance?
No, I think Neeraj, clearly numbers at the bottom line level have been definitely quite good. I think clearly, the base effect has also played out, and I would believe that, maybe in the next 1 or 2 quarters, as the phenol plant actually gets ramped up, possibly you could see better throughput and better volume numbers. But I think this number which the company presented in the third quarter is definitely a good one. I would believe that, sustainability of these numbers is now very crucial, and clearly this number definitely gives a fair amount of signal that within the specialty chemical space, definitely this could be a good kind of investment provided sustainability of the numbers continues.
Keep in mind for Deepak Nitrite, the phenol plant is an addition, and the plant started operating from December. The hope that people would have is that once this plant operates at 100% capacity, or whatever capacity utilization it operates in, but for all the 3 months, which is Jan, Feb, March, what's the kind of uptick that could come into the revenue numbers? I think that is what you would watch out for. Don't believe it's that margin accretive, because phenol isn't a specialty chemical but a commodity chemical, but it could be volume accretive, and that could help the business. Let's wait and watch what happens here.
All right, we've got a minute left to go for a market pre-open. I just want to get a few chart checks before we hit pre-open. Coming on an ICICI Bank, Ruchit, at 350.
So ICICI and Axis Bank, these two are the private sector banks which, if we see last 4-5 months, they have shown a good outperformance. Even now, since last 20-25 days, the stock has traded in the range of 335 to 380, and dips towards 335 have been bought into, because whenever the stock is moving higher, the volumes are good. So I think overall the trend still continues to remain positive till this level of 335 is intact. So any existing long positions could be held on with stop below 335.
All right. 354 on ICICI Bank, so around 335. That's where most of the accumulation comes in, according to Ruchit. 20 seconds left to go for market pre-open. The SGX Nifty trading 1/3% under, so weakened a little bit from the last time we took a check on it. The rest of Asia still holding up okay. So Nikkei 225 is up about 0.5%. Hang Seng is up about 0.2% right now. That's the SGX for you at 10,873. You're going to watch it for the currency as well. 71.26 is where it shut shop on Friday session. And that's the pre-open ticks up on your screen. Nifty opens under by about 0.5% while the Sensex opens up. But not to go by these prices, because they will change. Very volatile the first few minutes. We're going to take a look at a few other stocks. So Titan, a bumper quarter, really good numbers, beating street expectations, and at least for now, the first ticks showing you a 10% uptick on Titan. Bajaj Finserv is up about 2.5%. ITC has moved up too. That's up about 1%. L&T at 1335. You've got ITC moving up as well. Dr. Reddy's, UPL, HCL Tech, 0.5% gains coming in there. Eicher Motors moves up by another 0.5%. Tech Mahindra is up. Bajaj Auto is up. JSW Steel, Cipla, Sun Pharma, ONGC. Marginal gains but still in the green. Amongst the losers, Zee continues to grind lower. The stock is down 10% right now, even post getting that extension from its lenders. HDFC Limited is down 4%. You've got Reliance Industries down 2.5%. ICICI Bank down 2%. Asian Paints down 2%. And some of the other names from the oil and gas pack are GAIL and HPCL and IOC. These are looking weak as well.
And the ADAG pack is looking extremely wobbly after RCOM's news. But the management which is in the hot seat is DHFL. The woes don't seem to end. They are taking some moves to counter them. K Ratings, remember, downgraded the housing finance firm's bond and other programs amid the prolonged stress in the NBFC space. The company is trying to distance itself from the group firms as well, sold stake in Aadhar Housing Finance too in order to raise liquidity. This comes in the wake of that report which alleges that the promoters use affiliate companies to carry out quote-unquote scam. To clarify on some of these developments and discuss Dewan Housing's debt reduction plans, we are joined by Kapil Vadhavan on the phone line. Kapil, good having you. Thanks much for joining in.
Thank you.
The first point, before we get to the Cobra post and the allegations, I'm sure you've answered some of these, is the fact that because of the NBFC stress, the business did come off as well. Disbursements fell dramatically in the wake of the downgrade of the bond facilities as well. What happens next? I mean, how do you raise further money to take business ahead, and what's the outlook that you can give us?
Now, let me first address this by saying that post 21st September, when the liquidity crisis started in the industry, right? DHFL's franchise was strong enough to have gone out, done direct assignments of loans. And within a 3-month period, we were able to not just knock off the entire or almost the entire commercial paper that was outstanding, but also make other obligations good in excess of 18,000 crores. That includes CPs as well. Whilst we were focusing on coming back strongly from that liquidity squeeze, that has affected the industry as a whole. It is not just DHFL which got impacted. As you can see from some of the earnings that were announced for the quarter, a lot of the companies in the NBFC, HFC space have given absolutely subdued earnings. Now, having said that, the post the allegations which unfortunately surfaced against both DHFL and the promoter group, the voluntary action that is taken by the rating agencies actually came as a big surprise to us. Now, how can, when the fundamentals are strong, when there is adequate liquidity cover, when the ALM is not a problem, how can the rating agencies, purely on the basis of yield spreads and market volatility, take actions, which are detrimental to the company going forward? So yes, I mean, one, I don't really relate to the actions that have been taken by the rating agencies. Second, we're going to pick this up in the right forums, and would love to, I would like to, get answers to some of these from the right perspective.
I would presume that the rating agencies would get castigated if they do not take a call on the facilities of any company, not just DHFL, if indeed the share prices or the bond prices or the underlying have gone off. So in that sense, I reckon they would be doing their duty per se. But the question that probably anybody would want to ask from you would be that post all of this happening, what is DHFL doing in order to ring fence the interest of all shareholders, not just minority shareholders, but you as a promoter would be concerned with the kind of fall as well that has come in. So what happens next?
Surely. I mean, it is a matter of concern, and as you can see, the concern, we saw this happening post the allegations which appeared against us. Now, obviously, these are extremely unfounded, and we deny them vehemently. There is an investor call in the next 1 hour where we will be addressing specific concerns with respect to how unfounded these allegations are and how malified they are in their intent. But yes, I mean, on the other hand, we have also gone and during the same period done done a complete stake sale of Aadhar Housing Finance, which is one of the largest independent affordable housing finance companies in the country, and to none other than Blackstone. So stake sale in the asset management business, Aadhar, etc. Now this was business as usual from our perspective. I would only urge the bondholders as well as some of my creditors, to kindly focus on the facts which the company lays out. Obviously, the audit committee of the company under the aegis of the board is completely aligned to ensuring that all these false allegations which have led to some of these actions is addressed to properly and convincingly in the larger interest of all our stakeholders.
Right. Good morning, Devina here. Just coming down to the allegations then, and a three-part question. First, an allegation made that DHFL has lent to 6 developers, despite their net worth being less than 1 lakh rupees. They had no prior assets. The other one being the company lending 1,400 crores in 2016-2017 to 4 developers engaged in some rehabilitation, and that fund was used by these companies to purchase Darshan developer stake from Vidhavan Realtors. Was due diligence done when these loans were given up, and did you guys anticipate them buying a stake from the promoter entity? And the third part being another loan of 1,100 crores to 2 developers for picking up preference shares of the promoter entity. So 3 different allegations, 3 different loans given out, and whether due diligence was done in each of these cases before those loans were handed out.
One thing which I will always say is that absolute diligence has been done on all the loans that have been given out by DHFL, in its lending book. At the same time, coming to certain specific allegations, regarding the slum rehabilitation schemes. Now, these are schemes which are approved by the Slum Rehabilitation Authority. Your question around, SPVs having, small capital. Now, it is a known fact in the real estate sector that all businesses or all projects do get carried out under the SPV, under specific SPVs, and so was the case with these projects as well. The slum rehabilitation projects which are being undertaken in Mumbai, where close to 9,000 crores was lent, the asset cover that we have is more than 3 times in terms of market value. So yes, I mean, simply saying that this money was given to shell companies. Firstly, there is no shell company. These are all, legit companies undertaking specific, projects where we have gone out and lent monies to against full security of the projects. At the same time, there is no connection per se with the promoters. These are independent projects, and the independent projects, once they start realizing their cash flows, will give back the principal and the interest back to DHFL.
So, do you deny those 41 companies that were mentioned in the Copra Post allegation, as at all any of them having any related party interest?
There is no related party interest. Obviously, it alleges setting up of shell companies. I think it's relevant to note that not a single one of these companies was designated or described as a shell company by the Ministry of Corporate Affairs, Government of India, when it issued its list of shell companies in 2017.
So, Kapil, you or persons acting in concert, the promoters or the persons acting in concert within DHFL, have no ultimate benefits coming in from any of these companies to which the loans were lent to. You may have asset cover, but the net worth was low. You deny having any kind of ultimate interest into any of these companies.
Absolutely. I mean, not just DHFL's, but also the promoter and the promoter group denies these allegations vehemently.
How long would it take before the entire due diligence process is complete? I presume you appointed a CA firm to probe these allegations as well. How long do you think it will take?
The audit committee of the company has already appointed a CA firm. We are in consultation with the IBA. IBA will be appointing a joint, IBA impaneled, expert as well. So we would love to do this, extremely quickly in the larger interest of all our stakeholders, and an extremely efficient time-bound manner. Right. And this may not last for more than 3 weeks. We're going to push and get this report out as quickly as possible.
Right. So, Kapil, just one last question from me. While you're doing this now, that you've appointed your CA firm to do the due diligence, when the initial, complaint came about from a person called Vikas Shekhar, at that time, in the month of September, how come there was no proactive measures taken by the company to look into this matter?
This complaint actually didn't come out in September. Let me just clarify that. This was done in the month of December, and in the third week of December, fag end of the third week of December, the company got into action straight away. The company, took it up, with its board. We have actually gone and filed a counter complaint against these false, malified, allegations. Interestingly, the complainant went missing. All these complaints were filed from Delhi. The complainant went missing, and we have specific report even from the Economic Offences Wing of Mumbai to say that the address as well as the where the complainant perpetually resides is not even there. So we were cognizant of what was in store in terms of their next actions, but we were not obviously sure about the kind of allegations that will actually be thrown at the company as well as the promoters of the company.
Yeah. Kapil, one last question from my end too. How much money comes in via the Aadhar Housing Finance stake sale to DHFL?
So we're looking at DHFL will get a good windfall. It's more than 10x of their investment. I think more than 200 crores is what we are expecting. But yes, the stake sale is an extremely positive one. Which is at 3 times the book value of Aadhar Housing Finance. All
right. We'll leave it at that, Kapil. Thanks very much for joining us. Appreciate you taking out the time.
Thank you.
All right, that's the management at DHFL. Mr. Kapil Vadhavan trying to, douse the concerns of shareholders. Probably he's going to be joining in on a con call at 10 a.m. where he is going to be addressing more investor concerns, but vehemently denying any sort of, indulgement in terms of the loans that have been given out in a wrongful way without any due diligence that has been done.
Well, let's say it's not helping the stock for sure. 10% down in today's session as well. DHFL. Avinash, just a quick thought out here. 30 seconds.
Neeraj, I think one would like to wait and watch, because I would believe that despite these clarifications, the markets is not happy, and until and unless we get some clarity on the report which the management has stated, I would believe that till that time, doubts on the credibility and corporate governance would definitely continue to linger on the stock. So I think it's better to wait and watch rather than jumping and looking at the stock at the current odd levels.
Okay, let's nail it down to the one top idea from our experts. Ruchit, to you first, your top trading call for the day.
I would recommend buying Havells even from an intraday perspective. Although the earlier levels that I had given for us from a positional perspective, the pre-opening session is indicating a gap-up opening post the breakout on which we had seen on Friday. So one can expect a good momentum today also. For intraday, one can go long on Havells with stop below 724, expecting target around 760.
Brijesh, what about you? Your top call?
Apart from two calls, HCL taken long and Raymond short. I think one can look for Amar Raja long at around 765. It's opening around 765, and keep a stop loss of strict stop loss of 748, and can look for around 790, 797 level on the upside.
Okay. That's, of course, the call on the indices and specific stocks. Top calls for the day today. We're likely to start off flattish. The question mark only is, will the Nifty Bank lead the fall as it did in Friday's session? Here's how we're starting off. Well, about 0.5% lower for the Nifty Bank. The Sensex and the Nifty relatively flattish, but the Nifty Bank is worsening with every passing second. Now, about 2/3% in the red for the Nifty Bank. The mid caps and the small caps too should start off marginally in the red. The small cap mid cap index certainly does, down about 0.5%. Let's get the heat map up on the screen and show you what's moving and what's not. a tick of red. The autos are cooling off. Hero Motocorp, the numbers weren't the best, 2.5% lower. Indiabulls Housing, 3% lower. Zee, the formal consent with lenders fails to shore up the stock for the time being, down about 3% in trade. ICICI Bank, which corrected in Friday's session, also corrects in today's session to about 1.5% lower. SBI, which corrects about 1% as well. So banks don't have too much of a respite, to be honest. What is doing well? Titan, marginally higher, 2.5%. Vedanta about 1%, ONGC about 1%, Eicher Motors 0.5%, HDFC Bank giving that little bit of support to the Nifty Bank, right, I reckon. But otherwise, it's a tick of red and a fair tick of red. Yes Bank too, in fact, down about 3% in the session today. So fair degree of red on the screen. Let's see if it improves. The index though, about 0.25%. So the initial start about 0.4%, now about 0.25%. I believe banks are leading the charge downwards. Otherwise, it's still not all that bad. Devina, what are you spotting?
We'll start first with some of the movers in the broader market, like National Fertilizers, which is up about 3.5%. Future Lifestyle is up about 2.5%. The Godfrey Phillips is up about 1.9%. Should pull up some of those earnings-related companies. So Equitas, Divi's Lab, Deepak Nitrite, to see how each of them have opened up. Equitas is down about 2.5%. Divi's Lab up 1.5%. A strong quarter, but not a very big blowout of a response to the stock price. And Deepak Nitrite is the other one that we should look at in terms of the earnings performance and the reaction. About 1.5% higher. Suven Life, a 2% gain. DB Realty up 1.7%. You've got the likes of a Parag Milk Food, which just moved up. Minda Corp is up 1.48%. Jubilant Life is up 1.5% as well. Losers, Reliance Communications has dropped 41%. And that was probably something that you would have anticipated. They've moved to NCLT. Reliance Infrastructure is the other one that's down. You've got that down 7.5%. V1 Housing continues to reel under pressure. We just got some clarifications from the management, but that's not helping the stock price in any way. It's still down about 7.5%. Rain Industries is down 4.5%. Dish TV is down 4%. You should pull up the Zee Group companies, the SL Group companies as well. You should pull up Zee Learn, Zee Media. Zee Entertainment itself is down from the index. Zee Learn's not so much, so about just 1.2%, and Zee Media remains unchanged. That's
Harcom, Devina. Clearly the ADG group stocks under a bit of stress. Avinash, very quickly, what do you do with the other group companies?
No, I think clearly both Reliance Infra as well as Reliance Communication I would avoid. In fact, Neeraj, both these companies, the pledge has been significantly high. And I think if you look at the kind of overall undertone of these group companies, I think debt has been a large component of the fall. So I would believe that it's better to avoid, most of the group companies. I think for the time being, I think it does not make sense to actually enter at these odd levels.
Okay. Thanks, Avinash. Thanks so much for joining in today and giving us that perspective. Ruchit and Brijesh, thanks so much for joining in as well. Let's get in Vineet Thogde of Mirae Asset Global Investments, who joins us right now on the show and give us a sense of how global funds and global asset managers would be viewing the budget and the outlook ahead. Vineet, good having you. Thanks so much for joining in. I'm told you track India very, very closely from the Mirae side. What did you make of the budget, and do you think the markets would be a bit circumspect of the numbers the way they've been put out?
Clearly, on the budget side, it was broadly on expected lines. But if you look at the budget maths, on a headline basis, the assumptions are nominal GDP growth of 11.5%, tax revenue growth of 14%. But there's some devil in the details. If you look at specifically on the income tax growth, where the government is expecting close to around 17% growth, that seems a bit optimistic, especially after close to around 200 billion rupees of rebates they have given to the middle class. And secondly, one thing which has to be watched out for is the GST revenue growth assumption, which is 18%. A 13 to 14% number would have been more reasonable, a couple of percentage points ahead of the GDP growth. But it seems that the government is building in some increased compliance post-implementation of, say, invoice matching or streamlining of the processes, etc. So clearly, but it's not all is bad. If you look at the fiscal deficit target of 3.4% for FY20, it can be achieved, given that the 7th pay commission fiscal drag would be behind us, and it does create a room for the government to spend on the consumption-related schemes, which they have done.
Okay. The question, though, is that, and again, I don't know if you're budgeting this in your math or no, and if indeed that is turning out to be a consideration, that if indeed it's an expansionary budget, which it is, and if the revenue items are not completely clear, then do you fear that some of the places where the expenditure should have come about, namely capex related plays, would now get pushed back? Or do you reckon there are avenues which the market hasn't quite factored in? For example, the money spent behind PSU banks over the last 18 months, and that may not be required to shore up their capital in FY20, and therefore it eventually will match itself. How are you mapping that?
Obviously, this budget is more towards the consumption side, and capex is taking a backseat if you look at the numbers. But if you look at from a capex side, growth is picking up, as in growth had slowed down in the last couple of quarters because of the reasons of the past. And that's where, given an election year, typically the capex pushes less, the consumption pushes higher. So that's how this budget will play around in terms of consumption-driven story rather than a capex-driven one. And specifically on the PSU bank recap, a couple of the banks have kind of come out of the PCA, and we are clearly seeing lending growth pick up. So that should also be a bit more growth supportive as compared to last year.
Vineet, what's the sense that you get in terms of whether or not this kind of a move may actually crowd out foreign investments? Because it's going to be 2 years in a row that there has been a fiscal slippage, and even in FY20, there's no roadmap for fiscal consolidation. So the kind of impression that this creates in the mind of a foreign investor.
No, clearly, on the headline fiscal deficit, clearly, ideally one would have liked that fiscal deficit comes down. But apart from that, if you look at the net borrowing for the government, that's broadly been flattish in FY20 versus FY19. So that is a bit comforting on that particular front. And more importantly, if I look at within an emerging market space, India would be one of the only few emerging market countries where growth could be stable to improving in FY20 over FY19. So that gives comfort to the investors. And not just the growth, if I look at the rupee, where people were concerned last year, we have rupee kind of corrected a bit. Now it's kind of broadly fairly valued, and oil at 60-65. That also gives comfort to the international investors in that sense. But I agree, fiscal deficit certainly would have liked to be lower, but given an election year, that typically tends to happen.
What do you think the RBI is going to do now? Because on previous occasions, in fact in the last budget itself, when there was a fiscal slippage, the RBI had maintained that any form of fiscal slippage has a negative impact on macro financial conditions, which affect the cost of borrowing, which in turn feed the inflation. So at one point where you're saying you're comfortable on inflation, and plus obviously the yields have been rising, and on the other side with the slippage that could likely feed further inflation, what are the options? Do you think they can still hold an accommodative stance?
Clearly, I think the RBI kind of takes a bit of a pause right now. It's unlikely that they cut in the immediate policy meeting. And one has to watch out for how inflation trends pan out in the next 6 to 9 months. And clearly, the food inflation, which has been helpful on the headline inflation level, one has to see how this fiscal push towards consumption impacts the food inflation side. So clearly, RBI has got a tricky situation in front of it, given that we are not on the fiscal consolidation path. But unlikely that RBI cuts rates going into the policy meeting in February.
Aside from that, I mean, would you have liked it if there was a little bit more clarity in terms of, whether this is going to be a recurring initiative or just a one-time support?
It's unlikely that this is going to be a one-time support. It's tough to take all these kind of initiatives back. And that's where one has to be careful how we kind of take it forward from here in the next couple of years. Because once you kind of give these kind of SOPs to the farmers, to the middle class, it would be tough for any kind of government to take that back. And that's where the government has to generate enough revenues to support these kind of SOPs which they have given. And one important thing for that is going to be GST revenues going into next year. Hopefully, the compliance on the GST revenue side increases and the GST revenues improve as the kind of government is expecting. That could support the fiscal side of things for the government.
From an asset investor's perspective, there are a bunch of casualties in the last few days in India, Vineet. And yes, normally casualties do happen. But this time around, there are large companies which are showing those large moves downwards, with reason, of course, and refusing to budge back. How difficult is it making for an asset investor abroad? And is the mood right now of your peers out there of staying out of India until the clarity on election emerges in May?
Clearly, for India specifically, although India has kind of underperformed by more than 10% YTD, valuation premiums for India have also come down. But clearly, there is noise about elections in the next couple of months. But our view is basically politics and macro does just create a noise, and we finally get back to earnings growth. And that's where I believe everybody is looking at the earnings growth, earnings reporting season this quarter. And for the first time, we might not see earnings cut in India. And that gives us confidence on the earnings growth expected of 20% plus in FY20, as most of these earnings growth is going to be driven by the corporate sector banks. And for the first time, we get comfort because all these corporate sector banks have reached a provision coverage ratio of 70-75%. And the results have also been kind of comforting. So although the election will create a noise, and that will kind of give us opportunities to pick good quality companies at reasonable valuations, but finally the market will look at the earnings growth, and if we don't see any earnings cut, that would bode well for India in the next 6 to 12 months.
What is the expectation for emerging market currencies, and especially the Indian rupee now?
For emerging market currency, obviously the biggest factor has been a stronger dollar last year. But with expectations that dollar remains softer, emerging market currency should be reasonably well behaved next year. For the rupee, we clearly see rupee trading in this kind of a range because it's kind of come down to a fair value levels as compared to being overvalued last year. So we don't see much downside to rupee from here on.
And a similar view on the bond yields?
Bond yields have obviously reacted. One has to see how the demand supply dynamics work, especially in the first 6 months. But if you look at, unless inflation kind of inches up sharply in the next 6 months, bond yields look to be in this kind of a range where they are currently. We have seen a pickup in bond yields over the last couple of days post some fiscal slippages, but we don't expect any sharp movement on the bond yields either.
Vineet, I don't want you to give us a comment on specific stocks, but have the recent corporate developments in some large groups been of concern? Zee Entertainment or the Zee Group, the SL Group, case in point. Vedanta and what they have done in Friday's session, a case in point. And of course, what's happened with some of the NBFCs is a separate case in point. But these are not impacted by MDFCs per se, but moves that have resulted in strong price reaction. Have they been of specific concern to you?
No, certainly, as in we value corporate governance very highly in any of our investments, and corporate governance has to improve in some of the companies which you talked about. For that specifically, and in terms of NBFCs, we had seen a sharp growth as well, and tighter liquidity conditions have impacted them. So on that particular front, yes, you need some better disclosures from the companies which can help investors to take much more informed decisions.
And of course, in today's session, by the way, just want to mark that ADAG and Devina marked Reliance Communications down 36-37%. So that one is all soft, yes. But look at the other ADAG group stocks. Reliance Naval down 8.5%, Reliance Power down 7.5%. Reliance Infra is down about 5% as well. And mind you, this is a behemoth when it comes to exposure to bank facilities, etc. One just hopes that nothing untoward happens here, but that stock too has corrected about 4% in trade. So do keep these at the back of your mind. My final question, Vineet, and that is on the consumption space. We spoke about it. The jury is split right down the middle when it comes to autos. The last couple of months haven't been that encouraging. Maybe the Jain numbers by select companies looked okay. I don't know if the budget really gives so much of money in the hands of the mass that they will go out and buy cars and bikes. But what's your stance here on what is arguably the barometer of the Indian consumption space?
No, clearly, as in that is one area which on the consumption side we are seeing some kind of a slowdown, particularly on the auto side, both four-wheelers as well as two-wheelers. And from the budget perspective, given the kind of benefits they've given to the farm sector, the middle class, it's certainly not going to push high-ticket consumption. It could push low-ticket consumption for some of the cohorts of the economy. But even in the last couple of years, if you see on the four-wheeler consumption, we have seen very strong growth. And that growth has to be digested, plus liquidity has been tighter in terms of NBFC financing for that space. So numbers could remain soft in the near term for this space.
Right. Vineet, we'll leave it at that. Thanks very much for joining and appreciate you taking out the time. A quick take on what the budget doled out. On the other side, we're going to take a very short break right now, but we will be decoding the government's fiscal math and borrowing trends as announced in the budget with the Pranjul Bhandari of HSBC. After that, we will head over to New Delhi at 10 a.m. when Chief Economic Advisor Krishnamurthy Subramaniam joins us for a conversation on Budget 2019. Stay tuned.
City Union Bank, trust and excellence since 1904. City Union Bank, trust and excellence since 1904.
Today we are meeting Royston Abel, theatre director. Royston believes you don't need words to tell stories. There is no way to describe what Royston does, because what Royston does defies definition. Can you say that about anyone else? To be so fiercely individual, yet create music and theatre so accessible, so easily understood and felt and appreciated, not just at home, but the world over. When he turned his eye homeward, he created shows that travelled the world, bringing it a glimpse of our culture. The Manganeer Seduction, the Manganeer Classroom, 100 Charmers and the Kitchen. Watch his exceptional story, Pursuits by Skoda, only on Bloomberg Quint.
Anything and everything about your investments. We're just a touch away. Monday to Friday at 12:30 p.m. only on Bloomberg Quint.
City Union Bank, trust and excellence since 1904. City Union Bank, trust and excellence since 1904.
All right, welcome back. The interim budget has set a new record on the government's borrowing target. Gross borrowing has been pegged at 7.6 lakh crore in the next financial year. But there is a larger story that's now emerging with public sector enterprises, and a large chunk of the borrowing is now being done by public enterprises, including the Food Corporation of India. Pranjul Bhandari, Chief India Economist at HSBC, has highlighted exactly that in her post-budget report. She now joins us for more detailed analysis and a deeper insight into what exactly the budget has doled out. So, I'll start off with, what I just read out in terms of what's happening with regards to off-budget borrowings that have been on the higher side this time, and particularly from the likes of Food Corporation of India. What is your understanding of what's happening here, Pranjul?
Yes, thank you very much for this. So, the public sector enterprises in total have been borrowing quite a lot from the market. Between FY18 and FY19, it's gone up from 3 trillion rupees to 4.5 trillion rupees. This additional 1.5 trillion rupees, almost all of it can get explained by FCI. FCI's borrowing has really shot up, and in FY19 alone, it was 2 trillion. So a very big number coming from different sources in our view, from NSSO, from EPF, from LIC. This is money which the FCI was doing operations on, and the money was supposed to come from the central government, which has not come, and these are built up arrears over time, which the FCI is having to borrow on its own now.
So what does that do in terms of the overall reading of the math?
Well, the overall reading Right. So I think it's interesting to look at what PSEs do. You know, PSE borrowing has been going up a lot. All of it is not bad because some of it actually goes to do capex, capital expenditure. In fact, PSEs do far more capital expenditure than the central government on its own. You know, almost double. But the point is, FCI borrowing so much is actually not even capex expenditure. So you know, I won't like give it that, you know, the double tick mark that, you know, okay, fine, it's capex, you can borrow so much, and that's the problem. Look, when NHEI is borrowing, then, you know, you can see that it's going towards capex, and NHEI is borrowing quite a lot as well. But FCI borrowing is not even capex. So this is something we need to keep at the back of our minds, because now borrowing is shooting up quite immensely. You know, you have the central government, you have the state governments, you have the PSC. Each of them are increasing their borrowings, and when you get a sense that a lot of it is not going for capex, then it does put a lot of pressure, you know, on bond yields and for expenditures which are not capex related. So it becomes then a double whammy for investment in the economy. The government is not spending enough on investment, and interest costs are rising. So private capex is also not picking up in a meaningful way.
Used to be a catch-22, Pranjul. Good morning, Neeraj here. Because I mean, that's the worry, right? I mean, for example, one name that stood out was Food Corporation of India, and the kind of surge that's happened in the off-budget borrowings by FCI. So the question would be that if that is indeed going to be the case and the quality of the expenditure is indeed dwindling, do we forget any kind of capex spend by the government in the near future? Because frankly, from an equity market perspective, that's the big hinge of hope that people have, that capex will come back, led predominantly by the government, because that's the need of the hour.
Right. Look, you know, going into the budget, I think it was fairly clear that the government can do one of the two, a big capex push or a big consumption push. Unfortunately, we are not a rich enough government that can afford both at this point. The choice we have made right now is consumption, both for rural India and also for the middle class. And, you know, at this point, capex will just have to take a break. You know, the private sector animal spirits are probably not booming like they were in the past, and there was a hope that the government will lead the capex rise. It doesn't seem to be coming from the government right now. But look, all is not bad. Hopefully, the consumption push that the government is giving will, you know, have indirect beneficial impact on capex. And, you know, over time, private sector capex can rise. But for now, unfortunately, we're not seeing the government-led capex that a lot of people were hoping for.
Yeah, it doesn't seem like it'll rise in a hurry as well. The other question, and something that you alluded to, would be how the nature of the expenditure puts the pressure on yields. Now, the opinion, Pranjul, at least on Friday when we had the panel post-budget, was split right down the middle. There were a couple of people who mentioned that because of what the Fed has done, it leaves a lot of ammo in the hands of the Reserve Bank of India to take a rate action. Somebody went out as high as to say that he expects a 50 basis points cut. The opposing view naturally is that with the spike in yields that we've seen thus far, and the fact that RBI remains an inflation targeting benchmark or a framework, and the Iran treaty up for renewal in May, which might again put pressure, so on and so forth, all of those factors that you alluded to as well, ties the RBI's hands. What do you think Shaktikanta Das and team do this policy?
Yeah, you know, very nice question, and, you know, not an easy answer, to be fair. We are sort of in a very difficult period in terms of analyzing inflation. We have different components of inflation which are in completely different directions. You know, you have food inflation at -2, you have core inflation at 6, and you have headline inflation under 4. So headline inflation looks great, it's under 4, RBI should be cutting. But as soon as you look at core, you find that it's at 6%. And then you look at the fiscal deficit, and then you see that, look, it is a little expansionary in nature, and it is supportive of consumption instead of capex, and that's something which, you know, on the margin can be inflationary. So this is not a very easy decision for the RBI. You know, in our view, you know, we think the RBI will be on a prolonged pause. They will change their you know, from calibrated tightening to neutral, but we think they won't tinker with rates at this point. And the reason for that is, of course, the fact that the fiscal details look slightly inflationary, and the fact that core inflation is elevated. expected. But I must also point out that the risk to our view is that there could be a very gentle sort of a 25 bips rate cut, in the next couple of months. And the reason for that is food. Food is 50% of India's CPI basket, and it is, running at a negative clip at this point. And it can more than offset any of the pressures from oil or from core or from the fiscal as well. So, all eyes will have to be on food. And if food continues to remain low, then there could be a rate cut. But, we're not confident enough to make that our base case, and that just remains a risk at this point.
Just to follow up on that, because in the last budget, the commentary from the RBI was that fiscal slippage has a bearing down on the overall macro financial conditions. Your borrowing costs will increase, which your cost of borrowing funding will increase, which in turn will be a feeder for inflation. So if they go ahead and, in the current scheme of things, while the inflation looks a little more benign, go ahead and cut rates, how will they tackle if things start to worsen from here on with regards to the fiscal slippage and the rest of the cycle playing out?
Mm-hmm. Yeah, that's a great question. And, that's the reason why I'm calling for a prolonged pause at this point. I'm not calling for a rate cut. But, those who are still calling for a rate cut, you can see things from their perspective as well. And the point here is that every single year we've been talking about, high pressures from oil, from droughts, from fiscal slippage, from state deficits, and yet inflation has been stubbornly low over the last couple of years. So there's obviously something, in the nature of inflation that is changing, and I just don't think it's India. I think it's a global phenomenon at this point. So of course there are a lot of risks out there, but the truth is that there have been many risks around for many years which don't seem to have been materializing. So I see, what people who are calling for a rate cut are arguing. And yet, because I find that core inflation is so elevated, and I find that the details of the fiscal are showing that it is a little expansionary, I'm still sticking to my prolonged pause.
That's interesting, Devina. What a difference a few years can make. Sometimes ago, we used to use the term stubbornly for inflation staying high. Now we're starting to use that term stubbornly for inflation staying low as well.
Yeah. The other part being the announcement in the budget with regards to the projections on the tax collections and the tax revenues. Pranjul, what did you make out of their indirect tax revenue projections that they have made? They've also tinkered a little bit with the direct tax side with the kind of rebates that they've given up in terms of the tax bracket. How does that all play out in terms of the overall impact on the overall number?
Yes, well, the tax assumptions do look a bit ambitious, both for FY19 and FY20. If you look at FY19, for instance, take income tax. So far in the year, it's been growing at 16% year on year. But the ask for the remainder of the month from income tax is a growth of 44% year on year. So, that's ambitious on FY19. Let's move on to FY20. For FY20, the GST projections require a growth of 18% year on year. Currently, GST revenue has been growing at under 7% year on year. So that is also ambitious. So there are some ambitious assumptions out there, and there is risk of fiscal slippage, keeping that in mind at this point.
Does it concern you that it's been 2 straight years of fiscal slippage and no clear roadmap or a glide path for fiscal consolidation?
Well, look, it's been bothering me, but honestly, it's not bothering me newly right now. I have been writing about it and thinking about it for the last 2 years. It's very interesting that, earlier last year, we legislated the new FRBM rule, which mandates India to bring down the public debt from 70% to 60% by 2025. And in the same breath, in the same budget season, there were announcements, of higher MSP, of a new health scheme, of a couple of farm loan waivers, of several states. And now we have a direct cash transfer as well. These are all expenses which have some permanency built into them. So keeping all of this in mind, I think it does make this 60% debt target a little difficult. And that is something which is worrying, because if you look at, expectations of sovereign ratings upgrade, then those things fizzle out as soon as you realize that probably India is right now not in track of meeting its fiscal debt target. So there are things that bother me, and I think the bigger thing here is that if the government keeps borrowing so much, and not just the central and state government but also PSE combined, then the borrowing costs are going to rise in a fashion that private capex, private investment will get a little discouraged. So that's also something we really need to keep in mind. So these things, of course, do play in.
Yeah, unfortunately, I think industry captain after industry captain and over a coffee or otherwise do mention that they are not in a hurry to put in any kind of money until the government does that, and that too seems to have gotten pushed. Just wondering, from a market's perspective, the gross and the net borrowings, what do you think the market is focusing on more at the current point of time, Pranjul? And two, just a follow-up to all of that is well, that do you think that the number for FY19 assumes a lot in terms of run rate for tax collections, which might also, not quite meet up?
Yeah, so because we explained that the tax collection assumptions look a bit ambitious, there could be some slippage in the the 3.4% fiscal deficit number, especially of FY20. But it's no use factoring in right now because it's a long way off and a lot of things can change. We have been positively surprised in the past, and if tax compliance, especially for GST, picks up, then actually maybe the ambitious targets will be met. So while we worry about a slippage, we can't factor in as yet because it's just too early. But even if they do meet their fiscal deficit target of 3.4%, the borrowing calendar looks like a tough one. Gross market borrowing, especially 7.1 trillion, it implies a 24% year-on-year growth in gross borrowing. Remember, nominal GDP growth is growing at 11.5, so a 24% growth does demand a lot from the bond market. You have to also keep in mind that in FY19, the bond market got a lot of help from RBI OMO purchases. RBI did a huge quantum of OMO purchases. It is possible that next year RBI purchases will not be as much, and if that is the case, then it's going to be a double whammy for the bond markets. A high borrowing calendar and also not as much of RBI OMO purchases. So I think the bond markets will be on a nervous footing for a while here on.
All right, Pranjul, it was great chatting with you and getting your thoughts on Budget 2019. Thank you so very much for joining in.
Thank you.
Pranjul Bhandari there of HSBC. Moving on, Titan's Q3 earnings have surpassed all estimates, aided by higher jewelry sales. This segment continues to sparkle, posting more than 30% growth. But raw material costs went up more than 60%, and margins continue to remain under pressure. Nishant Sharma had a chat with the Managing Director, Mr. Bhaskar Bhat, and began by asking if the strong growth rate can be sustained in FY20. Listen in.
Well, we had a poor growth in Q1, if you remember. So the first half was a little subdued because of that. However, we did expect a surge in Q3, and we had planned as well a lot of activation, a lot of new product launches, and it's worked for us. So we made up a lot of the lost sales in a way by way of our targets. That kind of growth, of course, is difficult because Dhanteras is sitting in the middle of that festive season.
Right.
But the wedding season is continuing, and we should be able to achieve our goals, which we had earlier talked about. We had talked about a 25% growth in jewelry, and our target is still to achieve that for Q4, and overall at about 23%.
Right. And your margins have come off a little bit for the second straight quarter. Where do you see the pressure?
Margins have come off?
A little bit. Not.
Well, it's we had very healthy margin in the watch business for the first 6 months, but it was not sustainable at 18% odd. So the watch business had rescheduled its advertising to Q3, and a few other costs as well. So the watch division PBT dropped in Q3, and it's now averaging at 15%. So that is one of the reasons why The other reason, of course, is we have provided for another 70 crores for the ILFS.
yeah.
So there is no fundamental change in the health. It was a very good performance in the first 6 months from the PBT side, but otherwise the health of the company continues to be good. All divisions are doing well.
And talking about the ILFS exposure, last quarter 29 crores you saw provision. This quarter you saw 70 crore. Can you give me any further cues with regards to provisioning that you can offer?
Well, this is the right provisioning. It's based on our assessment of what needs to be done based on information available, and that's enough for now. What we need to do, if at all, we'll figure out in Q4.
Right. And talking about the watches segment, can you give me a split in terms of where you're getting the revenue from? How much of the revenue you're getting from the mass segment or that from the premium brand?
In fact, this year has gone well for brand Titan. Is growing extremely well, and that is also our most profitable brand. Also, one of the reasons for the dip in the margin in Q3 has been an extraordinary growth in the e-commerce channels, the marketplaces, which do their big billion day and so on. And those are basically lower priced watches that sell, primarily Fast Track and Sonata. And the proportion of these brands in the total sale has gone up in Q3, and that has also impacted margins. But for the year, the health of the business continues to be good. This is thanks to the recrafting that the business undertook a couple of years back, and it's playing out well. In fact, the new product introductions have done extremely well. The Raga I Am campaign, and then the Reflex, Fast Track Reflex Wave watch that we launched, band, is doing extremely well. So all the new products we've launched are doing well. We've had Grandmaster and Titan. Overall,
right,
the sales is good.
And how is the smartwatches category also doing? Can you give me more color on that?
We have, if I were to take the combination smart and wearables, our performance has improved considerably. We have become quite a significant player in the Indian market, and we will continue. In every brand now we have a smartwatch, Sonata, Fast Track, Titan, women's watches. That will only grow, and you will see innovations coming from Titan in that area. Of course, that's a very potential category. So I think we are in a good space. We have the regular analog watches and the smart watches, and both have their customers. This one, of course, is growing much faster. So the new age watches and channels are the ones which are growing much faster than the traditional channels and watches. But the traditional watches are also coming back in a way.
Right. So do you think that the new age watches will play a larger role in terms of driving revenues going forward? And when do you see a larger pie of that coming from?
Certainly growing, and over the next 3 to 5 years it will become much bigger, because the traditional analog watches, the rate of growth could be 5 to 7%, whereas these will be in excess of 25-30%. So the proportion will change. The challenge will be, so the volume gain is what we are looking at, and in our watch business, as you gain in volume and scale, the profitability goes up manyfold. So that's the good news in the watch business.
But the competition is also higher in the smartwatches category.
Well, with our distribution strength and our brand strength, we are already ahead of many of the small competitors. If you're talking of the Apple and Samsung, they are another category league already, altogether. And yes, they are competition, but we look at this movement as an opportunity because it has expanded the wristwear, category, and the need to get something onto your wrist, whether it's a health tracker or a fitness band or a traditional watch or a mechanical or quartz. It's good news for the watch business, for the watch industry, in fact.
Right. And also, what is your e-commerce strategy looks like?
E-commerce differs from business to business. If you take the watch business, it's on our own site as well as we are on the marketplaces. Eyewear is very unique. We do a lot of innovation in eyewear through our partnership with CaratLane. And in jewelry, CaratLane is the larger e-commerce brand. Tanishq is primarily its own site. So it depends on the kind of customer that you have, because jewelry, at least the kind like Tanishq and Zoya, are brick and mortar brands.
Right, and I'm talking about the eyewear segment. The losses have narrowed. At one point in time, you expect to see, profits coming consistently.
So our strategy of scaling up, we have set for ourselves a goal by 2023 of touching 10 million customers per annum in this business. And that target we are well on our way achieving, and this year's volume growth is a big turnaround. We were doing 1-2% same store growth. Now we are at 12% same store growth and total growth of 27%. So it is through entering newer price points without losing out on margin, but at the same time correcting the price perception. See, there is a fair amount of growth in this industry, but the kind of quality that is being offered by some of the very low-end players is suspect, and that's not good for the industry because it is about your eyes and vision. And we have stayed the course, wanting to offer a very good solution for your vision. At the same time, we've now started distributing our frames. We started manufacturing frames, and we've got a large number of satellite lens labs now to be able to give quick delivery of lenses to customers. So it's a journey we are very confident of. It's a very underserved market and can only grow.
And you mentioned about offering low price point products in the eyewear category as well. What's on that?
We've already offered. We are still seen as a higher price player, a premium player, but that is because a lot of the so-called mom and pop stores who don't have properly trained optometrists and who at least earlier were not paying taxes in a way. There is a lot of unorganized in this, and they were able to offer low prices.
Right.
We, through our now manufacturing of our own frames and smart sourcing and our own designs, are now able to, and because of the volumes, we are able to get better prices. So it's a new price point, not a drop in price.
Talking about the innovation, you mentioned we spoke about the smartwatches category as well, how you're also innovating in. What kind of push is there as far as the innovation is concerned, as far as, Titan?
Well, Titan, push on innovation is no longer specific. The company has been, in some way, fortunate enough to have an innovation culture. So it is primarily in product, and you are seeing a lot of innovative products being launched all the time. In smart, if you see, it is more, we are a late entrant in that category, but the way the wave, gesture band has worked, and that's, we have the slimmest in that category. So those are innovations. Apart from that, there are continuous innovations in customer experience in the store, in the manner in which we woo customers through analytics. We now have a separate digital team. So it is across the board. I can't pinpoint one big innovation like the Edge or something today. It's become a part of our DNA, if you say.
Right, and just one more bit. How do you see the contribution of the revenue coming from watches and eyewear segment going forward?
Well, watches has come back to growth in the double-digit space. Eyewear, of course, is, as I said, is at 20+%, 27% combined, same store, and total is 27%. So we do expect to grow at that rate. Next year's targets are different, but this year we will achieve that growth rate.